The Orange County apartment market continues to hum along at a solid pace, but a notch below the revenue growth levels it was accustomed to seeing prior to the recession. Will 2014 bring any additional momentum? Welcome to Apartment Market Dynamics from NPF Research. I'm Jay Parsons with your Orange County update. Orange County often gets grouped with Los Angeles as one of the sexy six markets, but like LA and a few other high-profile markets, Orange County has not seen the kind of rent growth equivalent with that sort of hype. That's not to say that performance has been bad, not at all. Let me illustrate this for you with a chart showing year-over-year rent change in Orange County versus the U.S. average. And what you see is that Orange County has routinely outperformed the U.S., at least from 2002 to 2007. But in the downturn, rents here took a bigger hit, and we saw this in L.A. as well, more volatility in pricing compared to the national average. And then they were also slightly slower on the rebound. And now for the past 2.5 years, Orange County has been right in line with the national averages for the most part. Again, that's not bad because average in this case has been very good in the last 3 years. Now, the Orange County has maintained a little bit of a premium in the past couple of quarters. As of Q4, Orange County topped the national average 3.6% to 2.9%. So is this a sign of things to come for Orange County, or is this a blip? And there's some mixed signs coming out of the Orange County apartment market that tells us there's a range of possible outcomes for Orange County's apartment sector. All of them are healthy, but the question is just how good can revenue growth and rent growth in particular be in Orange County? One factor is looking pretty strong. That's the key demand driver, jobs. Take a look at this chart showing annual job growth levels in Orange County. And what you see is that job growth levels are back to the norms we saw from 2003 to 2006, with just over 30,000 jobs added in 2013. That's an expansion rate of 2.1%. Healthy, though not spectacular. The downside, though, is that Orange County's employment base is still down more than 3% compared to pre-recession highs, and that puts it below the national pace. And more worrisome, perhaps, is that jobs coming back are not necessarily the same as those that were lost. And the jobs that are being added back in tend to be lower-paying jobs than the ones that were lost during the recession. A lot of the jobs that are coming back tend to be lower-paying health categories or restaurant and bar jobs. Now, those are all types of jobs that tend to be good for the apartment sector in terms of demand, but not good in terms of rent growth potential, since there tends to be a income ceiling for those types of jobs. On the flip side, Orange County is deeply in the red for jobs in finance, insurance, business services, all the types of jobs that help drive rent growth potential higher. Another factor facing Orange County is supply. Orange County is on track to add just over 5,000 units in 2014. That is a high number for Orange County, but it's not overly aggressive, amounting to an expansion rate of 2.2%, only moderately above the U.S. average. The biggest chunks of new product are coming into two Irvine submarkets, north and south, where the Irvine Companies has a major product underway in both. Also a big construction number in Huntington Beach at 934 units. The good news, though, is that Orange County has done a good job absorbing what has completed in the past couple of years, and occupancy has been in good shape. Right now, it's at 95.9%. That was up 40 basis points year over year, and occupancy has been in that 95.5% to 96% range now for 2.5 years. That's a hair below the pre-recession norms here, but still quite healthy. So what does all this mean for 2014? We think that occupancy cools down slightly, mostly due to the new supply coming in, and that rents grow another 3.4% in 2014. And that wraps up for Orange County. So until next time, for Apartment Market Dynamics and NPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.